The Fed has deployed unprecedented quantitative easing in history by utilizing $2.86 trillion on its balance sheet in order to keep the short term interest rates to near zero level. Remember, the Fed has already injected a mammoth dose of $2.3 trillion into the financial system since the collapse of Lehman Holdings in September 2008. The probability of the Fed continuing this stance of keeping rates on lower end would most likely continue. The key drivers are the slumping mortgage insurance and ailing housing markets. Any increase in rates would put unbearable pressure on $914 billion of mortgage backed debt of the Fed. Concomitantly, the Obama administration is struggling to close massive federal budget deficit of $2 to 4 trillion. In this environment, treasuries are more likely to rebound in the short term, while yields on treasury inflation protected tips would escalate in the long term. In my viewpoint, any unstoppable escalation of this spread between the two, which would run somewhat parallel to an inverted yield curve, would signal potential threat to the global economy. Here is the economic story behind the key trend witnessed recently. Number one, burgeoning fiscal deficit would prop up the national debt of the US unless domestic savings are capable enough to fill the gap, which is not the case. Number two, deficits and national debts cannot go beyond certain threshold without inflicting damage to the economic balance. This is true in case of the US as well as although the Fed can print dollars literally from thin air as long as it wants to do so. Number three, if debt exceeds permissible limits, the first thing to do to be hit will be the interest rates. Higher rates will cause insurmountable burden on debt servicing as well as dampen the consumer demand. Note, consumer spending impacted directly by the strength of the housing market is the main driver of GDP growth in the US. Number four, higher rates will prove detrimental to a very fragile housing market, which is already facing pressures from an ailing mortgage insurance market, a new emerging trend. Number five, remember that any quantitative easing by the Fed will keep rates low in the short run, but will come at a cost of burgeoning national debt and consequent expectations about inflation in the future. Number six, bonds, treasuries as well as debentures move in an opposite direction to interest rates. Future expectations of lower yields would mean higher price compensation for bonds. 7. Finally, interest rates and inflation would move hand in gloves. In this game, expectations are the key determinant of any future play out. Markets are driven by psychological factors, greed and fear, as much as by fundamental factors. In my viewpoint, presently the psychological factors, fear in particular, have masked the fundamentals to a great extent. The solution lies in a firm commitment of the Fed and the government to keep the fiscal deficits and the national debts within a plausible limit of the GDP.